A central bank digital currency, CBDC, is an electronic form of money issued by a central bank. It would exist on the same platform as other bank accounts and be available to everyone. This video will look at what a CBDC might mean for consumers, banks and businesses. Easier access to cashless payments. The rise of cashless payments is one of today's most important trends in the global economy. Since 2016, the number of consumers making digital payments has doubled and continues to grow as more people become comfortable using their phones or other devices to pay for things. This trend offers many benefits: easier to use, less expensive than cash and cards, and safer from fraud than physical currency. But there are also challenges regarding ensuring that everyone can participate in this new way of doing business, especially those without access to the internet or smartphones, which may be financially vulnerable or live on low incomes. If you go on to like today's video, please don't forget to like and subscribe. That's where central banks play their role. By providing an innovative solution that makes it much easier for all citizens to access cashless payments, even those who do not have bank accounts, central banks can help ensure financial inclusion while promoting economic growth worldwide. 1. Improved efficiency of monetary policy. The efficiency of monetary policy is an important topic for central banks. Digital currencies can reduce the cost of implementing monetary policy, improve efficiency, and lead to better balance sheets for central banks. In many countries today, most people don't use cash anymore. Instead, they pay with debit or credit cards in stores or online shops. They also transfer money using mobile apps like Venmo or Zelle. These transactions are not settled directly between two parties but through financial institutions such as Visa or PayPal. 2. Increased resilience. Central bank digital currency, CBDC, can help to increase resilience by reducing systemic risk. It does this by providing a new source of funding for financial firms in times of stress and therefore helps to reduce risks associated with reliance on short-term wholesale funding markets. That said, there are other ways in which CBDCs could improve resilience. By providing an alternative source of liquidity, they can help prevent financial panics from spreading. 3. Reduced banks costs. The main advantage of CBDCs is reduced costs for banks. Cash management costs are reduced because using a CBDC would eliminate the need for banks to manage physical cash. This would also allow them to avoid storing large amounts of cash, which increases security risks. In addition, the cost of printing paper money could be eliminated and replaced with digital money issuance. Transaction costs are also reduced because no actual payment needs to occur when two parties exchange funds. Instead, they update their balances in their accounts at the central bank, and so on. Moreover, transactions previously not possible electronically due to high fees can now occur much more cheaply, thanks to lower processing fees. 4. Better privacy for consumers. A central bank digital currency, CBDC, benefits beyond making payments. A key advantage of CBDC is that it can be used without revealing the user's identity, allowing them to make transactions without being tracked or identified by third parties. In addition, as a result of this anonymity, consumers will have more control over their data because they won't need to share it with merchants or other financial institutions to make payments using their CBDC accounts. 5. More opportunities for innovation. Central bank digital currency could be used to test new technologies. For example, it could deploy mobile payments in countries where existing payment systems need to be more mature. It could also be used as a tool for financial inclusion by providing access to safe and convenient mechanisms for making payments through mobile phones or computers. Central bank digital currency could facilitate the creation of new financial products unavailable due to regulatory requirements or technological barriers. These include digital bonds, i.e., bonds issued on a blockchain. Tokenization of securities, i.e., the ability to trade assets directly on blockchains. A central bank digital currency could serve as an alternative to physical cash. Using a central bank digital currency could speed up payments and reduce the cost of making transactions by reducing the number of facilitating intermediaries. Central banks can alter interest rates by changing how much they charge or pay for transactions on their digital currencies. However, a central bank digital currency could also pose some challenges. For example, it could make existing payments less attractive because they would be offered at a lower interest rate than the central bank's digital currency. In addition, a central bank digital currency could increase the volatility of money supply and inflation if an equivalent increase did not match its creation in economic activity or credit creation. As we've seen, central bank digital currency offers many benefits that could benefit consumers and the economy, which is one reason why central banks worldwide are considering it. But there are also some potential drawbacks to consider. One big concern is privacy. While most of us think of cash as anonymous, it isn't. That's all for now. Let us know your thoughts in the comments down below and don't forget to subscribe to my channel.